Afternoon and welcome to our second insurance pricing webinar of the year. Today we'll be looking at how prices have moved throughout 2020 and what we could expect to see coming up this year. First, a little bit of background for those of you who don't know us. At Pearson Ham, we help our clients improve performance through pricing in several key areas, from pricing strategy and planning to improving effectiveness through systems, processes, and governance. We also can take this through to implementation, including predictive modeling and price optimization, so the nuts and bolts of pricing. As well as an internal focus, with our clients, we have market price tracking services, which provide a daily update on competitor movements in both car and home insurance markets. And that's what we'll be using today to look at how prices have moved. If you'd like a bit more information on this, then you can click on our guide using the chat pane to the side, so there should be a link there for you, or you can click through to our Insights webpage using the link there as well for some more information. If you have any questions as we go through, then please feel free to log them in the chat page, and I will attempt to answer as many of those as I can at the end of the presentation. Okay, so today, as I say, we'll be looking at how prices have moved in 2020, how the announcement by the FCA around the dual pricing remedy has impacted, and what we might expect to see this year as we look forward to the regulations changing. What would we expect to see in terms of impact of that? So the data we'll be using today comes from Pearson Ham's Consumer Panel Price Tracker. And this involves a panel of real people with real risk details who have been recruited for this purpose. And we run quotes through 4 main comparison websites. So we see here Compare the Market, Confused, Go Compare, and Money Supermarket, collecting prices on a daily basis. We ensure that our panel members are refreshed and updated regularly, so that there's no kind of negative impact and it doesn't influence the prices that are being returned. And we also conduct some data cleansing and removal of outliers to make sure that what's being reported on is actual price movements in the market, and not prices changing as a result of something to do with the data collection. So whether it's to do with the timing or the days or the number of quotes that certain individuals have run, we try to take out anything that might be impacting prices outside of actual price movements. We provide daily reporting to our clients via an online portal. So this shows price movements for the previous day, along with other useful metrics. And on our monthly portal, there's a greater depth of analysis available and additional metrics which allow some scenario modeling to be conducted and looking at factors outside of price for a real kind of product by product comparison, so including features and benefits. Okay, so that's where the data is coming from, and what have we been able to see through it? So what's happened to prices in 2020? So as we're all aware, there's been a lot of things happening in the market in 2020, not least of these being the outbreak of the COVID-19 pandemic. So this has obviously had a huge impact on motor insurance prices in particular. So working from home caused insurers some massive logistical challenges, particularly where you have large call centers, and all of a sudden you're now being asked for your workers to be working from home. So again, there are some kind of significant challenges in being able to manage that. So we did see some price increases coming in as insurers kind of struggle to kind of address that and reduced the volume of calls coming in while that was being sorted out. So we did see kind of price movements as well as changes in quotability to help kind of relieve pressure while some of those logistical challenges were addressed. We've also seen reduction in mileage, so and the subsequent impact that's had on claims frequency. So insurers' margin and potential profitability has been increased because of the reduction in the volume of claims that were expected when the prices were originally set. So that has also had an impact on the market, and we've seen some refunds being offered, as well as kind of prices being reduced to reflect that. We've also seen an increase in the demand of new propositions, such as pay-as-you-go, and an increased number of these entering the market. So customer demand has picked up, and so has the number of propositions available for them to choose from. There's also been mix change as a result of the pandemic and the lockdown. As we've seen driving tests being cancelled, then there are no new drivers coming onto the market, so a reduction in the number of young drivers entering the market, and as car dealerships are unable to open, it also means there are fewer new vehicles coming onto the market. So new drivers dropping out, new vehicles dropping out. Where people are unable to work from home, commuting by car has increased, so that's a preferred, safer option to public transport in many cases. So we've seen a bit of a shift in the types of people who would normally be on the road. So overall volumes down, but a bit of a shift in terms of the profile of drivers out there. So I think in summary, we can say there's a lot of moving parts in 2020, which will influence pricing both in an upward and a downward direction. So there's been a lot of disruption, a lot of price fluctuation. So let's have a look at what we've actually observed. So between January and December, we saw prices drop by about 5% for our consumer panel. This compares with other figures in the market. So 6% drop was being reported by Confused.com and a 3% drop by Money Supermarket. So we are kind of in the middle there. The kind of methodologies vary slightly, and we would recommend that when we are kind of looking at market movements, then look at all available sources to give you the most rounded view. So your mix of business will be kind of unique to your own business. So it's clear that the kind of you will vary slightly from some of those market indices that are out there, but it's worth, in order to get a kind of a more rounded view, to look at Confused, look at Pearson Ham, look at Money Supermarket, look at the ABI figures, and all of those together will give you a kind of a more rounded view of what's actually happening, and you'll be able to use that in your planning. So let's break this down into quarters. So the start of the year, we saw prices increasing. If we cast our minds back to what was happening in January, February, then we were being hit by several storms. So there were storms Kira and Dennis, which struck in February before the pandemic hit us. So we were seeing the start of some price increases in the market even before the pandemic, which then did result in some prices increasing further in March. And I think a lot of that was to do with some of the logistical challenges that insurers were having in the market, having to relocate call center staff to work from home and everything that goes along with that. As insurers managed to address these challenges, then we then started to see the impact or expected impact of reduced claims frequency being factored into pricing. So where prices had increased, they then came down again in Q2, but to a greater extent than they had originally increased to. So I think insurers there were starting to kind of think about, well, the mix has changed. The expected claims frequency is going to be vastly reduced because of the lockdown situation that we find ourselves in. So there is potential margin there to play with, and it is possible to reduce prices to try and kind of drive additional volume with the expected benefits that we would get from reduced claims frequency. Competition intensified into Q3 with everybody chasing the same volume. At the same time as this, the market was shrinking. So obviously there's no new drivers coming into the market, and we saw record numbers of vehicles being taken off the road. So the benefit of the reduced claims frequency was becoming clearer, and the extent of it was becoming clearer, and reducing prices along with the rest of the market wasn't necessarily driving the expected uplift in business for many insurers. This is what kind of intensifies the competition. You're investing, you've got the money to invest, the margins are improved, or expected margins in terms of improved loss ratios. So you're able to invest, you're not getting the return because everybody else is doing the same thing. And that, again, creates this kind of race to the bottom and the downward spiral that we've been seeing. Into Q4, competition continued to drive prices down until the end of the year, when we did see a bit of leveling off and some slight price increases. If you look at the Money Supermarket Index, then they are reporting larger increases towards the end of the year in Q4. Confused.com reports kind of similarly to us, where prices have continued to drop down into Q4. So I think that there's probably been a little bit of leveling off, maybe not as much of an increase as Money Supermarket are reporting in their observed average quoted prices. But with regards to our methodology, where we're using the same people, so the same individuals, we've seen a slight kind of leveling off and a bit of an upwards movement in the last month of the year. So our average movements often mask more complex underlying activity at an individual provider level. So some of the large brands, and these are in the top 10 of comparison site insurance providers, reduced rates by as much as 10% throughout the year. So the cohort that we're looking at here, we can see prices have come down between kind of 5 and 10% over the course of that period. So again, if you are competing against these guys, then that's going to cause you some challenges. If you're in the same footprint, then you may find some of the smaller reductions you've been putting through haven't provided the same return as you would have expected. And this kind of goes some way to explaining that. Other large brands were a bit more restrained. And 2 of the top 10 we see here ended the year with rates slightly higher than the start. So I think if you are kind of in the same footprint as these guys and competing directly, then you're going to be in a much stronger position with regards to your trading throughout the year. So what of the FCA pricing remedy and the proposed ban on dual pricing? What do we expect to see there? So I think we would expect this to drive further volatility as we go through this year and into next year. And we see that happening in 3 distinct phases. So in stage 1, which is from now until the regulation takes effect, and that might be August at the earliest, I would say, possibly later. It may even be pushed back until next year. We are kind of in the consultation period, so there are a number of questions that have been raised with the FCA that they will need to investigate and come back with responses on. So it's still unclear as to exactly when that's going to happen, but later in the year, we would expect the kind of the regulations to take effect. During this interim period, then I think we're going to see insurers jockeying for position. I think we're going to see some price reductions coming in to drive volume. We're also in a new lockdown, so again there are benefits of reduced claims frequency. So there is that additional margin that insurers have got to play with. So I think there are a couple of things going on. So the additional margin enabling prices to be reduced and the market to balance, to rebalance, and we may see insurers and brokers using this as an opportunity to try and drive as much business as possible now, while they're still able to invest in lower acquisition prices. So from now until the regulations taking effect, there's still an opportunity to invest in lower acquisition prices and then to raise the price when it comes time for those customers that you've acquired to renew. So there's the margin benefits and also the volume drive. Stage 2 is following the implementation of the regulations and for a further 12 months. So as new business and renewal prices align, we expect to see some large variances between what was paid last year and the renewal price. So even where the differences that we're seeing are price reductions, so there may be some kind of significant drops that customers are seeing, then that could still result in increased shopping around activity. And likely that some good deals will still be available as insurers adapt to the new situation. We have, in our experience and across many different books of business, seen this impact of retention rates falling as prices vary from what was paid last year. And that can be, as I say, in either direction. So either a price increase or a price reduction can still trigger that shopping around activity. So customers may be looking at that and saying, actually, if this provider is able to offer such a good price, maybe I'll be able to get a better price in the market, or have I been ripped off in the past? And that might trigger something. And we have seen this even where there may be stages that the customer is going through which they would expect to see price reductions. So if they're kind of gaining an extra year's no claims, or if they're kind of moving up the age scale and would expect to see a reduction, even when you kind of normalize for those types of things, we do see retention rates dropping with that variance. So we'd expect to see a little bit more shopping around stimulated in phase 2. So that's the stage from implementation of the regulations to kind of 12 months following that. Stage 3 is implementation plus 12 months and beyond. So where the new business price that we paid last year is aligned with the renewal price. So I think following a full year of alignment, we would expect to see less differences in year-on-year prices and some settling down in the market. However, with prices being linked to acquisition rather than capped and collared, we may see some big year-on-year movements driven by changes in kind of risk expectations. So for customers where shopping around has become the norm, then they're likely to continue to do so. It's been a long time, and people have learned over a number of years. So over the past 10 years, people have been learning to shop around when it comes to renewal, don't accept the renewal price. And the vast majority, particularly in motor insurance, of customers will be looking at comparison sites when it comes time for them to renew, either to switch or to use that information in a negotiation with their existing insurance provider. For others who are less likely to shop around, then we probably see an improvement in renewal rates. So if somebody's been on the cusp of shall I shop, shall I not, then probably more likely that they will just stick with their existing provider. So I think we'll see an improvement in retention rates there, but where people have learned over the course of 10 years to shop around, it's going to take some time for them to develop new habits. So what we're hearing from our clients is that it's going to be crucial to understand how their competitors are moving during each of these stages, and being able to respond and react quickly and appropriately. So how might different organizations respond to the upcoming change? Well, we may see prices dropping initially as insurers and brokers try to drive more business ahead of any increase in acquisition rates. So I think this may be what we have been observing since the change, along with the improved margin benefits. The regulation affect new business renewal pricing rather than year on year. So it's an opportunity to drive that lower acquisition business and then increase rates when it comes to renewal. More investment might be made into data enrichment and individual pricing to be able to target more effectively the most attractive and profitable customers. And I think that there could be kind of increased improvements in model sophistication, particularly in risk modeling, as this element increases in importance, and being able to have as much information about any individual customer that you can get that's going to inform that will be very valuable. We may see new economy propositions. These are likely to be developed and allow insurers and brokers to maintain the top of screen positions, even where the acquisition prices for the standard policies have to increase to rebalance with the renewal prices. There may be opportunities to increase the product offerings and the just by changing the product benefits and features to be able to maintain those lower priced propositions. There may be some cases for differential pricing at renewal based on specific risk factors which may not be known at new business. So I think there are some questions for the FCA around, well, what would constitute the equivalent new business price, where there are pieces of information which may not be available to you at new business. So I think those are things which still need to be ironed out during the consultation period, and which will have to be resolved prior to the regulations taking effect. Obviously, there will be a rebalancing between new business and renewal pricing, but this could be targeted with greater reductions for some customers being offset by increases for others. So we kind of on average, the kind of renewal prices are too high and new business prices are too low. But when that rebalancing takes place, it doesn't necessarily need to be the same across all segments, and certainly not from all insurers. So really worth understanding who's doing what and when they're doing it, to be able to plan what your response should be. So these are just a few of the potential approaches that we may see in coming months. But overall, as I say, we would expect new business prices to rise and renewal prices to fall during this rebalancing. But as I say, it's going to be a period of disruption, which is going to go on this year, next year, and into the following year, as well as we progress through those different stages. Have we seen any immediate responses? Well, let's look at what's actually been observed since the announcement. So September the 22nd was when the announcement was made. So the market report was published by the FCA. We did see 1% increase from one of the providers on the next day, and another increase by around 2% a week later. So these may or may not be driven specifically by that announcement, but our tracking enables you to see on a day-to-day basis who's doing what. And if these are your competitors, then you may have expected some improvements in your competitive position over those 2 weeks following the announcement. which could be impacted by this. However, overall, the market remained fairly static. So looking at that, the red dotted line in the middle, that's the average of the top 5 market prices for our panel of consumers. So we didn't really see much movement. So there were a couple of increases here. A couple of brands had started to put price reductions in. There was a reduction on the 22nd from one of the insurers here, and another put a reduction in on the 25th. So fairly inconclusive, but it's worth having that day-to-day view to be able to see exactly who's doing what. This has been anonymized for the purpose of this presentation, but our clients have access to see exactly who those insurers are and a good understanding of whether they're in the same competitive footprint, using some of the metrics that we have available in the portal to be able to see when you are in the top 6 positions, who else appears in those top 6 most of the time. So you can get a really good view as to who your real competitive set is, and an understanding of how that's going to impact when they change prices. So as we look forward, what can we expect to see this year in market pricing? So far this year, we've seen prices falling further. So the chart here shows January movements at minus 1.6%. So from December to January, prices have dropped by just over 1.5% for our panel members. So this follows this slight leveling off, an increase that we saw in December, which may have indicated the start of a longer-term trend of increases. However, that has been reversed, and we've seen price reductions happening again. So, I mean, this could be the expected increase in acquisition prices driven by the change in regulation looks to have been trumped by the new national lockdown and the implications that has on insurer margins. So how do we expect things to progress this year? Here are some possible scenarios that we've been looking at. So as I say, margin implications of lockdown have resulted in prices dropping. Competition is putting pressure on the pre-implementation acquisition strategies, so driving new business in before the regulations take effect. So I would expect to see prices to continue to drop over the next few months. So given that we have gone into this lockdown and it's been extended, we're now looking at potentially Easter before we come out of it. So I think there are kind of the margin implications mean there is the potential for insurers to reduce rates, and also looking at that acquisition strategy in advance of the regulations taking effect. I would expect prices to continue to drop, really close to, if not right up to, when the regulations come in. So as we move into Q2, we may see prices start to level off a bit, and they could increase depending on updated claims predictions. But given the extended nature of the lockdown, I'm not sure that would happen. Some insurers may be able to maintain lower rates, and they will benefit from the volume uplifts. It really depends on how kind of bullish you're being about your kind of predictions on improved loss ratios through the differences in claims frequency that are expected. So some may be doing it, some others may be a bit more kind of reticent to continue those price reductions. So I think we'll see some prices leveling off and maybe some increases as we get to the middle of the year. There has to be a rebalancing. I think it's clear as kind of new renewal prices will have to come down, acquisition prices will have to come up to kind of rebalance to an extent. And ultimately we'll have to see increases in new business rates following the implementation of the new regulations. And however, this might not happen right up until after the regulations have been implemented. And that's looking at August, potentially at the earliest, really. So I think what we're looking at in terms of price movements this year is really a game of two halves. It's where prices are going to continue to reduce. We've got the benefits of the reduced claims frequency. We've got the acquisition strategies. And then we've got the implementation of the new regulations, which is likely to force prices upwards to be able to kind of rebalance acquisition and renewals. Okay, so at this stage, I will answer any questions that have been logged in the chat. So I'll just have a look through those now. So do you expect any new product launches as part of this? Yes, I think I mentioned earlier, this question may have come in before that, that one of the areas that the FCA has said it expects competition to remain intense, it is by differences in product features and benefits and levels of service. So I think that that's one element, so that we may see new enhanced products as well as new stripped down products, which would enable insurers to maintain top of screen positions even where they have to rebalance and acquisition prices are increasing. So the kind of the relative change in kind of the standard product can be offset by the introduction of new economy products. So I would expect to see more of those being launched as we progress through the year and into the kind of the midpoint to the kind of second half of the year and into Q3. Has the increased competition harmed the industry? I wouldn't necessarily say it's harmed the industry. I think the improvements in margin or the expected improvements in loss ratio through the reduced claims frequency means that it is possible for prices to be rebalanced. I think that the kind of where insurers may be looking at increasing volumes and be frustrated that any price reductions they're putting in are not driving those volumes because everybody else is doing the same thing. I think it's not necessarily a harmful thing to the industry, but I think it is something where acquisition prices are kind of rebalancing and the market is reaching its natural state. Do you still see a place for brokers in the aggregator motor market post-dual pricing? I think I still do. I think there's still a place for brokers. And as I just mentioned, one of the areas that they may still be able to compete in is looking at the different levels of service and the different product benefits and features that are being offered. So what's the added value that brokers are able to deliver? So I think that there's been an argument for a number of years about whether there's still a place for brokers in the market. Is there still a place for brokers in the aggregator market? But our brokers have managed to do very well within that environment. So I think there is still a place, and it's differentiating and doing what you can to stand out from the competition. So we've got a question. Have you spoken about COVID and FCA? Have you considered any influence from whiplash reform? Yes. So I think there is a lot of things going on. There are a lot of moving parts, and that's something that will continue into this year. So I think when we're looking at what do we expect to happen, then there are things which are pushing prices down. There are other factors which are pushing prices up. So it's quite a difficult one to call. So it's looking at, well, what are all of the different influencing external factors? Which ones do we think are having the biggest effect? And where do we expect to see the biggest impact happening? Okay, great. There are still a few questions here which I will endeavour to answer directly with the individuals by email outside of this. I think we have to draw this to a close. So as I say, please contact me directly if you'd like to know more about our daily motor and home insurance price tracking tools and insights and how they could benefit your business at this uncertain time. So it is certainly a time of real change in the industry, and having a regular, accurate view on how prices are moving on a daily basis is going to be invaluable in 2021. So our clients are already including 7 of the top 10 comparison site insurers, so they realize the value of maintaining this daily view. So if you want to know more, then please get in touch. There's another guide here which is more around our insurance consulting services outside of market price tracking. If you'd like to get a copy of that, then please click the link and you'll be able to download that. So thanks for joining us. We are planning to have some more of these sessions, so maybe more regular updates into market price movements and what's been happening. So please stay tuned, keep looking at your emails, and we'll be sending out some invites to upcoming webinars very soon. Thanks very much. Bye.